Well, g'day there, everybody. Thanks a lot for joining me as at this Monday afternoon market recap. I wanted to point out a couple of things in regard to the current formations in the marketplace and also some chart patterns that some people in particular are picking up on and are bringing to my attention. Yes, I am very much so well aware of these patterns, one of which is a potential leaning double top here. And I just wanted to point out from the outset of this recording, no matter even if we do see a little bit of a sell-off again, continuing potentially back on down into this green rectangular box, ultimately we are still looking at these markets pushing back on up above the swing high that we have priced in the month of March and also towards the back end of February. But ultimately, to take out the swing highs, depending on which market you look at, either back in September or back in October of 2018, let me just show you what I do believe is under construction on the marketplace. So if you're just looking at this from a chartist's sort of perspective, again, you're picking up on these two sort of dumpling rounding tops. The most recent one of which is specifically that, or at least lower as to where we were in the month of February. Now, again, this is really looking like that of a head and shoulders, a double top. Now, if you pay attention, of course, to the exponential moving averages, technically speaking, even today during Monday's session, we did come on back down for the second time in roughly 2.5 weeks and actually retest this rising 50-day exponential moving average. In this particular instance, it is a little bit premature, at least, to say that the market itself is trending. However, if you look back a little bit retrospectively, whenever we have come on back down and actually pulled on into the 50 or even at higher levels, most recently over the past 3 months, it has been, of course, that buy the dip opportunity whereby the markets again continue in the direction of the prevailing trend. Now, again, just to recap, the prevailing trend on the macro time frame going all the way back to 2009. I understand my chart looks very ugly. There's lines all over the place. These are support and resistance areas going back really to about 2005, 2004. That's why we've got a ton of these sort of horizontal blue lines on my screen. But again, these markets are still macro bullish as long as you remain above this sort of purple colored or this magnetic colored extension out into the future. The same is true for the S&P 500. Again, if you take the swing lows dating back to 2009, we tagged in 2011, tagged it again in 2015, 2016, and most recently towards the back end of 2018. As long as these markets again hold up above their respective extensions, which is this very strong sort of thick default line projecting out into the right, we're still macro speaking up in that of a bullish extension. Now, if I bring back up the Dow Jones Industrial Average, I just wanted to show you how much support is still underpinning this market. I've shown you those rising exponential moving averages. The simple moving average, technically speaking, they are still moving sideways. So I guess the angle of these moving averages, although we have seen recently the 100 push below the 200, it looks as though, again, the 100 is starting to slope up. And it is ultimately, if we see price action continue, going to take out the 200 simple moving average once again. But for all sort of intermediate trend, when you're just looking at, I guess, the longer term simple moving averages, these are still largely flat, which brings us essentially into these oscillating indicators. Now, this is where a lot of people are going to get unstuck because what they don't seem to understand or realize, or at least accept even through to the current juncture, is that we are still technically trending. Yes, it doesn't look all that strong on the exponential moving averages, but think about that macro primary bullish trend. Think about the December swing low, right? The retest of that very important trend line which held up in really the first 3 months of 2019, which have been exceptionally strong, of course, to the upside. Yes, I understand that it does look as though we'd have that of a leaning double top. Yes, I can see that. Yes, of course, the oscillators are still weak. It looks as though we tried to actually price in divergence, even though we don't technically have perfect or at least ideal or textbook divergence. You can certainly see weakness in these oscillators when it comes to momentum. Now, the reason for that is because obviously we've moved a long way off from, and really since January, or really the 26th of December, we have pushed very aggressively, very violently to the upside. And as such, naturally, these are going to become extremely overbought, which they have been towards the back end of February. And as such, the market is going through a little bit of a breather. Now, in the past, we've called for corrections, especially during this little period here. In fact, we were looking at the market during this sideways step, or at least sideways sort of consolidation, this stair-step pattern, to potentially come on back down and retest the trend line. That never played out. We've continued to the upside. All right, we've gone through that first little mini correction. We've seen that secondary bounce, and as such, the oscillators have tried to once again push back on up into overbought territory. Now, as it stands, it's failed. Now, Monday, of course, came along and we did see a little bit of selling. Oh, sorry, pardon me. Let me take that back. On Friday, we saw a little bit of selling. We were left with one black crow candlesticks. Today, we saw the spinning top candle set up. We didn't see any follow through. I was really expecting follow through to really eventuate today. We really didn't see that. The Dow actually closed positive. The other markets were net negative only ever so slightly. But again, this is coming into that battle of that rising 50-day exponential moving average at the moment. What would be interesting to see is whether or not we actually break below the neckline, the hypothetical neckline of this leaning double top, but I wanted to give you a very sort of stern warning at the moment, and it has been the warning for quite some time. A lot of people are again talking about the sort of the imminent recession factor at this particular juncture based on some of the economic signals that we pay attention to externally outside that of the technical analysis. We still have at least really 12 months to run on this bull market, and that's giving us adequate time, so to speak, to actually take out the all-time swing highs. Ultimately, we are looking at this market on a macro time frame to inevitably and ultimately shift from a macro bullish sort of trend in economic expansion since 2009 ultimately into that of a reversal, a big macro reversal into that of a bear market at some later state. Now, I understand a lot of people, again, are talking about some form of a large topping pattern, whereby that is the left sort of shoulder over here. We've got the head, which is developed in August and September of 2018. And then, of course, we've got the continuation, or what deemed at the moment to be that of the right shoulder. And I just wanted to warn you that a lot of people, if we do see continued sort of weakness in the market, as soon as we crack below the neckline, they are going to turn aggressively short on the market. However, in my humble opinion, it is going to be short-lived. What is most likely going to happen is that we are going to set up a reversal very close to or in this green rectangular box. We don't have to get all the way down into this green rectangular box. We're going to take it obviously day by day. But I wanted to warn you that if you are looking at, I guess, jumping on the bearish sentiment, all right, it is somewhat dangerous to do so. The reason for that is because, again, even at the current time, we don't have confirmation that we've even broken the primary bullish trend line, which has been in effect since 2009. So really, you've got this much support. If I can just show you it in the screen. Now, this is only pertinent to that of the industrial average, but really to sort of zoom in and give you a microscopic sense of where that support critical sort of phase or area is. It's really in this green rectangular box, which is, pardon me, at this point in between, or within mostly anyway, this sort of square on my screen at the time being. So again, pay attention, look for the reversal candlesticks. We may even reverse off from this 50 exponential moving average. And ultimately what you're going to want to watch for is the ADX to turn up and the CCI to strengthen once again above that positive 100 reading. At the moment, we're printing at 60 or very close to 60. This is quite positive. It is firming up, as one would say. And ultimately, as long as we remain above roughly that 50 point on the CCI and we don't see a major technical downswing, this market is just simply buying its time, or at least it's marking time, until ultimately we see that bid come back into the market, which may, again, wouldn't, just looking sort of externally into the prism. I understand a lot of people will probably be somewhat surprised by that. All right, there's a lot of obviously stories going around about the global growth slowing and things of such nature. But as it stands, again, based on, depending on what economic indicators you look at least we've got another 12 months, all right, comfortably. Okay, until we would become imminently concerned about the sort of the markets or the equity markets pricing in that of an all-time high, and ultimately the reversal sort of pattern that we are going to look for. Now, we're going to monitor the head and shoulders chart topping pattern, but as it stands and the way we are approaching this market is that this is going to be a buy the dip opportunity once again, and it's most likely going to come on the back of a technical whipsaw, a false break to the downside, which is very quickly reversed, and then, of course, will result in that of a short squeeze to take us out not only above the swing high that we priced in on Wednesday of last week, but also back towards February. And then ultimately the all-time highs on the markets collectively back towards the late stage of 2018. That is the Dow Jones Industrial Average. The same is true for the S&P 500, again, holding up. I'm not going to go into as much detail on this particular market, but you can see we were left today as at Monday with a spinning top. We closed down 2.37 points. And again, on the NASDAQ, very similar to the S&P 500, we closed down 5 points, but we are very nicely sitting on that rising 20-day exponential moving average. So I would encourage you to check the technical signals, especially if you are somewhat looking to imminently short the market. I do believe it is rather dangerous. And just to sort of bring this full circle at the moment, even if we did see the reversal come on back down into this green rectangular box, if you think about this horizontal sort of support line in the past, which is held up in the months of October and also in the months of November, and then potentially think about this as an inverse head. And then if we were to sell off and then stabilize around 24,500, that would really begin to look like, even though it is technically incorrect, an inverse head and shoulders pattern, which again leads us, or at least ultimately that pattern breaks to the upside once you break above the neckline, which is essentially what we've been pricing in over the past really 1 month, all right, back to February and most recently last week in the equity markets as well. So again, we're just simply marking time, allowing the market to sell off if it chooses to do so, not aggressively shorting into any weakness in the market, but in fact looking to buy the dip, or at least continue to walk and stage and layer into longer term option positions on the long side, and then ultimately be paid out once the pressure cooker and the foundation, right, breaks above what has been a rather sort of rectangular type of pattern over the past really 1 and a bit years now. So I mean, it's been going on for quite some time, almost 1.5 years if you want to go all the way back to October, November 2017. And as such, once we break above the highs of these resistance areas, you're going to see most likely the equity markets move into that sort of parabolic blow off top, which then we will begin selling into, right, when the time is right, and becoming very much so, I guess you could say, defensive on the market, okay, looking for that macro reversal to take place. Right, so if you have any questions at all, please email me, success@pivotpoint-trading.com. Until next time, everybody, remain safe, remain patient, okay, be disciplined in your approach to the market, because again, ultimately those who can sort of persist through this and not necessarily put themselves into a spot of bother or corner themselves, say for instance on the short side, that's really where the danger is at this particular juncture. You're going to be rewarded ultimately with your patience as the market pushes on, back on up, and takes out these two swing highs to begin with. All right, so that's going to do us. Again, any questions, email them through. Otherwise, I'll see you later in the week for another market update. All the best, everyone. James signing off on behalf of Pivot Point Trading. Goodbye.